Hey everyone, Richard here from TraderLion.com, and today we're going to be talking about the A in CANSLIM, which stands for annual earnings. And this is one of the 7 key characteristics that William O'Neill, the founder of Investors Business Daily, determined was critical in picking the greatest winning stocks of all time. And last week we covered the current quarterly earnings, which is the C in CANSLIM. So go ahead and check out that video if you haven't yet. After watching this one, it will be linked above and in the description. So first things first, what did William O'Neill say about annual earnings and why is it so important? So first of all, in How to Make Money in Stocks, he says, any company can report a good earnings quarter once in a while. To make sure that the latest results aren't just a flash in the pan, it's important to review the company's annual earnings growth. And this is true to make sure that there's consistency. It's not just a one-off quarter, and institutions definitely want to see an increasing trend and ideally an accelerating trend in those annual earnings. And secondly, he says that you should select stocks with a 25 to 50% or higher earnings growth rate, and that the average growth rate for the biggest winners, going back to the 1800s, per his study, was 36%. So this metric is incredibly important. You want to see consistent growth, but also very high growth, and that's what's really going to drive those large stock price increases. And number 3, from his study, 3 out of the 4 big winners showed positive annual growth rate consistently over the past 3 years. So once again, consistency is incredibly important. We don't want to just see one quarter, 1 year where it's incredibly big. Consistent and ideally accelerating earnings year after year. That's really what's going to catch all those institutions' eye and get them to invest in the company. And number 4, the earning stability over the past 3 years is consistent, and the earning stability metric ideally is low. And a normal kind of growth stock will have an earning stability of 20 to 25, and a more cyclical stock, which kind of has fluctuations in its earning stability, will have about 30 or higher. So ideally, we want a low metric here that shows consistent growth, and obviously institutions want to kind of know what to expect from their stocks, and a kind of low earning stability is preferred. And lastly, we've got number 5. Obviously, O'Neill was looking for both outstanding annual as well as quarterly earnings to get both pieces of that. And that's what's really going to drive institutions to invest into a company, which will drive up the stock's price. So that's kind of the main things that O'Neill says in How to Make Money in Stocks about annual earnings. And I think it's great to kind of do a brief slide about how annual earnings are calculated, because I think there is some confusion here. It's not just an addition of all the quarterly earnings. Instead, it's the net income of that year minus the dividends and one-time costs divided by the weighted average common shares. So this slide basically shows a few examples. We've got Ford in 2017, net income $7.6 billion, and you can see there's no dividends here, so you just divide it and you get a basic EPS of $1.91 per share. And Bank of America is a little bit different because there is a dividend here, so we just have to subtract that out before calculating that basic EPS. And lastly, we've got NVIDIA, which, like a lot of other growth stocks, doesn't give out a dividend. And you can see, like Ford, it's just a basic calculation and division. And this is the general formula for the non-GAAP EPS. And both of these, the table as well as the formula, is from Investopedia. And along with annual earnings, I also want to discuss return on equity, which O'Neill mentions in the book. Basically, going back and looking at the greatest winners of all time, almost all of them had ROEs of greater than 70%, and superior companies have an ROE of 25 to 50%. So they're very effective with using their capital and equity. And ROE is calculated right here, net income over the shareholders' equity. And throughout the video, I thought we'd go through a few different examples, starting with Tesla, which kind of show the power of annual earnings and how this trend can really translate over to a stock's price. So pay attention here to both the kind of numbers here, which are the EPS each year starting in 2013, as well as the estimates for 2020, and also the estimate revisions, which are indicated by these arrows right here. If it's a red down arrow, that means that the most recent revision is downwards. If it's green up arrow, that means upwards. And this screenshot over here was taken in the April timeframe, so right before this massive 500% run that Tesla had in 2020. And you can see that the estimates for 2020 are up 999%. The estimate revisions are downwards, but when you've got revisions this large, this number doesn't quite matter as much. And you can see that not just the estimates for 2020 were enormous. For 2021, we had a further increase of almost $9, it looks like. So the analysts were really kind of bullish on Tesla. And really, that's why all the institutions and funds piled into the stock, which led to this incredible price increase of well over 500%. So I thought Tesla was a great example of the power of estimates. And you really want to pay attention to this number when it's over 50 to 100%. Moving on, we've got the trade desk, which is a more subdued, but nevertheless a very impressive run in 2020 compared to Tesla. And over here, we've got the same earnings here, the estimates, and also the estimates for 2022. So we see a gradual increase here, a steady growth. You can see that the earning stability here is 8, so very consistent. Institutions love that. They know what to expect from this company. And the return on equity as well is at 41%. So this is kind of in that 25 to 50% range of really superior companies who know how to really effectively manage their business. However, looking here, we do see that the estimates for 2021 are actually down from 2020, which might play into this basing period in the stock's life cycle, although you do see it picking back up in 2022 with the estimates being up 27% from this previous year, and the estimate revisions being up as well, which is a good sign. So that is TTD. I thought that was a good example of very consistent growth and also very strong return on equity and very low earnings stability. And moving on, we've got PINS, and this was taken just a few weeks after the huge earnings gap up after they reported earnings right here and had a lot of bullish things to say about how they'd be monetizing their platform. And overall, you can see that in 2020, it was just basically supposed to earn the same as in 2019, but at this time, analysts were kind of upping their predictions for 2021, basically multiplying that EPS times 20. So this is a very significant change. We've got estimates of 999%, the most recent revisions up as well, and this stock basically tripled from this point. So once again, pay special attention when you see estimate revisions this large. And lastly, I thought we'd finish things off with a more recent example. We've got AMAT, which just broke out to all-time highs. And looking over at the earnings, you can see very consistent growth. And then from 2017 to 2020, it kind of oscillated between $3 to $4. And then in 2021, it's estimated to have kind of a breakout year. And this means that it broke out of this range. And you can see that estimates are up 44%. Estimate revisions are up as well. And then there's further growth expected in 2022. And pay special attention to something like this where it's a breakout year, because that can really lead to dramatic price increases in the stock. And overall, looking at the return on equity, it's also very strong, just like TTD at 41%. Earning stability isn't quite as good. You can see it's at 28, so it's a little bit up and down, as you can see from the stock price here. But overall, once again, a very strong record of annual earnings increases. And great expectations for 2021 and 2022. So that is a few examples of how to apply the A in CANSLIM. Essentially, you want to see kind of improving earnings over the past few years, low earnings stability, ideally, great return on equity, and pay special attention when you see that the earnings estimates for this year or the next are over 50 to 100%, and also that the estimate revisions are up as well. So I hope you guys enjoyed this video. If you did, please go ahead and leave a like down below and subscribe to the TraderLion channel if you haven't already. And I'll see you guys in future videos.